Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us for the segment, we have Mish Schneider, Director of Trading Education over at Market Gauge. Mish, it's great to see you as always. Welcome back to Trade Talks.
Nice to see you, Jill. I'm happy to be back.
Yep, and we have a lot to cover now that we finally have something new to talk about despite macro headlines with bank earnings coming in, really kicking off the earnings season for us over the next few weeks here. And it's interesting because let's talk about JP Morgan specifically. They did well with consumer deposits, yet their CEO, Jamie Dimon, is not that bullish on what's coming up over the next 6 to 9 months.
Yeah, that's an understatement. He's kind of come out and said that we're going into a recession and he thinks it's unavoidable. So I would say that the bank earnings are very interesting in that they belong to a sector that has relatively outperformed the market, particularly regional banks. It's the only one of the sectors that we're watching of our economic modern family, if you look at KRE in particular, that hasn't broken down under the 200-week moving average. And I think yet has to be at the end of that sentence.
Yeah, and of course, we've got CPI data came in hot yesterday. I thought the market reaction was really interesting. I mean, NASDAQ 100, for example, down 3% in the futures and then came back to rally nearly 2% at the end of the day. We haven't seen that kind of swing in over a decade.
Yeah, I think it's only happened 3 times in history. But if there's anything that we've seen over the last few years since pandemic is that whatever relationships have historically worked before, you could probably throw them out the window this year. Everything about this year is different. And of course, the major reason besides the inflation numbers is that the Federal Reserve is finally doing, obviously late, but still doing what they said they were going to do, which is try to stop the back of inflation by raising rates. So you have the inverted yield curve at levels you have not seen through the 1980s. You've seen the long bonds, which almost looked like they were going to stabilize, actually starting to rise in yields again. And there's really nowhere to run or hide in the market right now, which is unfortunate on so many levels.
Yeah. There's a number of managers that are in a lot of cash for that reason. And I think to your point, we are at an interesting inflection point because it seems as if there's 2 ways we can go here. We can test those lows and see if we can maintain them and perhaps just, bounce around over the next 6 to 9 months, or we move through those lows and it gets a little bit ugly below that.
Absolutely. And this is why we love technical analysis. I mean, obviously, you and I have spent the last couple of years talking a lot about the macro, and it's important to understand where you are in space and time. But what I found on these longer term charts, these monthly charts that you're referring to, is that there's a moving average that measures a 6 to 7 year business cycle. And if we look at the 3 key areas of the U.S. economy and the sectors that are related to them, of course, 3 of my modern family, right? So you've got the Russell 2000, the transportation, and the retail, not the consumer discretionary necessarily, not particularly just e-commerce, actually a nice blend, which is why I like XRT. And what's so fascinating is all 3 tested the low of that 6 or 7 year business cycle. And yesterday, when the market came in much lower, that was actually the low, almost to the tick, particularly in IWM, of that moving average. So that tells me one of 2 things. And it's a horrible thing to say. It's a bit of a waiting game here, but it's also probably the most responsible thing than saying, oh, we've hit a bottom or we're going to tank another 20%. And that is, if you just look there, if these recent lows at 162.50 in the Russell 2000 hold, and we can see 195 hold, let's say in IYT, and I think it's around 54.55 in the XRT. We don't know what the news could be that could make it so, not that we're bullish, but at least that we're not going into that deep recession that everybody's so concerned about. On the flip side, if we do break that, then whatever capitulation that people keep thinking happens but hasn't actually happened yet, we could actually see that, and we could see a period of pain and then maybe that sort of trading range stagnation kind of thing that we've been expecting every time we hit a new nadir in the market.
Yeah. It's interesting. I've had a number of portfolio managers on this week talking about small caps, to your point with the Russell 2000, that yes, this is a very stock picking actively managed environment right now. It's kind of hard to paint a broad brush, as you had mentioned, but small caps kind of don't have as much as that macro exposure, and it kind of is a good spot to pick and choose some names here.
Absolutely. And it also defies everything that we've seen over the last decade, which is everything's been led by tech and growth. And the big cap stocks are really having trouble surviving in this environment. And another member of the family, SMH Semiconductors, broke the 200-week now. So, but it's still pretty far, by the way, from that 80-month moving average I'm talking about. It comes in around 145, which just shows you how much more downside we could have before that might actually see some level of capitulation. But, I guess the message is if you talk to some of the brightest people and the most experienced people, and everybody's saying, at least the people that I admire and respect, the same thing. This is an active trading market, mainly in cash. And if you're patient long enough, at some point, we'll be able to put that money back to work. But the time is definitely not here, at least not right now.
All right, Mish, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.